Well, hello again, Solis family. Greg Solis here with our update. First of all, I hope everybody enjoyed that Super Bowl. What a great game. Goodness gracious. Those are some talented athletes out there. Really enjoyed it with family and friends. Had a great time. I hope you did as well. Team here at Solis Wealth Management is doing great. We got just a phenomenal team. Hopefully you're getting information on some of our new members. Luis and Kimberly and just the whole team here is just doing incredibly well. So thank you for your trust and confidence. I can never say that enough. We really do appreciate you here at Solis Wealth Management. On the market side, it's been a relatively good few weeks. I mean, year to date, frankly, we've moved along quite nicely. The S&P 500 is up, right around 7-8% year to date. So that's a pretty good run. From the bottom from what we hit back in October, we're up quite nicely. The bond market has seemed to stabilize a little bit, and we're getting nice yields on some of the bonds right now. But it's really a tug and pull between, are we going to slip into a recession or is the economy still too strong? We are certainly seeing a resilient economy that doesn't want to slow down too much, even though the Fed has raised the rates quite a bit. Retail sales just came out for January, and we're up about 3%. That's still pretty strong. The consumer price index came out for January, and it was hovering right around 6.4%. That's coming down, but probably not enough. It did hit a high at 9.1%, so we have brought it down quite a bit with the Fed raising rates as much as they have, but it's very, very sticky, and it's pretty challenging. So the Fed is 100% committed to trying to get those inflation numbers down. They would like to see the inflation number, measured by the consumer price index, at around 2%. So we got a ways to go. So the question is, how much more are they going to have to raise the Fed funds rate? You've heard me say this before. We're now anticipating that we're probably going to have at least two more at 0.25%. So probably going to see the Fed funds rate get upwards of 5.5%, 5.75%. Then maybe they'll be able to slow down. Maybe we'll see the economy start to slow down, but we've seen a tremendous amount of resilience on this economy. And so most of the analysts that we follow, that we really respect and like to listen to, see perhaps a mild recession, not a deep, long recession. And if that's the case, perhaps the market is already pricing in a recovery. I think what we saw in 2022 was the market pricing in the recession for 2023. Earnings have come out. They weren't real impressive, but they weren't bad. So the economy overall is chugging along pretty good. And so that's kind of giving a lot of optimism that maybe we won't have a deep recession and the Fed might be able to orchestrate a soft landing. That's best case scenario. That's our base scenario that we believe will most likely happen. And so therefore we believe the market rallying the way that it has is probably okay. It's probably warranted for an economy that's going to slow down but not go into a deep recession. So we stay cautiously optimistic for 2023. Accounts are looking a lot better for sure. 2022, as we know, was a brutal year. 2023 is starting off reasonably well. So from our end, we're looking pretty good. If there's questions, thoughts, concerns, we're here for you. Never hesitate to call. Take care and God bless.